In the wild world of trading, what if the secret to winning wasn't about adding more complexity, but about stripping it all the way? Today, we're diving deep into the leaked strategy of the top G trader, a philosophy that's all about radical simplicity. So let's start with a feeling I bet you know all too well. You're staring at your screen and it's just a total mess, right? A jungle of lines, colors, maybe a dozen different indicators. You have to ask yourself, is all this stuff actually helping you make better trades, or is it just noise?
This really gets to the core of the problem. This quote says it all. Indicators tell you to buy after the big move has already happened. Think about that. Most of the tools out there are designed to confirm a trend, but by the time you get that signal, the party's practically over.
Which leads us to our first big idea, ditching lagging indicators. The whole philosophy here is that these tools don't actually give you an edge. All they do is put you right in the middle of the herd, usually at the absolute worst possible time. So what exactly is a lagging indicator? Well, it's pretty simple. It uses old price data to tell you what to do right now. The key word there is lagging. It's always one step behind the real action. It's kind of like trying to drive a car by looking only in the rearview mirror. It just doesn't work. And this is where the real danger is, the trap. Picture this. A stock shoots up from $2 to $5. Your lagging indicator finally wakes up and flashes a big buy signal at $5. You've completely missed the main move, and now you're being told to risk a ton of money for a potentially tiny reward. The game is rigged against you from the jump. Okay, so if we're going to throw out all the complicated indicators, what are we left with? Well, the price itself. This entire strategy is built on one simple, powerful idea. The chart is just a story. It's the story of every single transaction that has ever happened, and our only job is to learn how to read it. You know, this isn't some brand new idea. It's got a super long history. It started with ancient merchants literally just putting dots on paper. Then, centuries ago, Japanese rice traders had a brilliant idea. They started connecting those dots, and boom, the first line charts were born. What we use today, candlesticks, is just the latest evolution of telling that exact same story. Every single candlestick on your chart is a little chapter in that story. And it's not complicated at all. It just shows you 4 key pieces of information for any period of time: where the price opened, where it closed, the highest point it reached, and the lowest point it hit. That's it. It's a clean, simple summary of the battle between buyers and sellers.
So this leads us right into the first pillar of the strategy: technical analysis. Now, hold on. This isn't about memorizing 100 different complicated patterns. No. It's way simpler. It's about understanding the basic structure of how price actually moves.
See, this whole approach really stands on 2 pillars. You've got technical analysis, which is all about reading the story inside the chart, the history of what's already happened. Then you have fundamental analysis. That's about understanding how the story outside the chart, news, world events, economics, can suddenly change the entire plot. So how do you actually read the chart structure? It really boils down to a super simple 1, 2, 3 pattern. Let's say you're looking for an uptrend. Step 1, find a low point. Step 2, find a high point. But step 3 is the magic moment. You watch for the price to pull back, and if it makes a higher low than the first one, that's it. That's your confirmation. The trend is up. All right, now for that second pillar, fundamental analysis. Because let's be real, a chart doesn't exist in a vacuum, right? The real world has a huge impact, and understanding the simple basics of supply and demand is absolutely critical. Just think about it like an iPhone launch. The day the new one comes out, everybody wants one. Demand is through the roof, but there aren't that many available, so the price is high. Fast forward a year, old models are everywhere. Supply is high, demand is low, and so the price drops. The financial markets work on that exact same simple principle.
And here's the best part. You do not need to be an economist. You just have to pay attention to the 3 big news events that cause the biggest waves. First up is the FOMC. They're the ones who set interest rates. Then you've got NFP, which is the big jobs report. And finally, there's CPI, which measures inflation. Seriously, if you focus on these 3, you can pretty much ignore all the other noise.
Okay, this next part is where we get into the really advanced stuff. This is the master level concept, and it's all about understanding why so many of your trades seem to go wrong. It has everything to do with a trap set by what we call smart money. Let me ask you this, because I know every single trader has felt this pain. Have you ever put on a trade, set your stop loss, and then watched the price go directly to that spot kick you out of the trade, and then immediately turn around and rocket in the direction you predicted? It's not just bad luck. That incredibly frustrating experience actually has a name. It's called inducement, and it's not random. It is a deliberate, engineered fake-out by the big institutions, the smart money, to trick regular traders into jumping into the market too early. They're setting a trap. So here's how the trap works. Smart money will create what looks like a perfect, obvious support level. Retail traders like us see this, we get excited, and we place our buy orders, putting our stop losses just below it. The big guys know this, so they push the price down just far enough to trigger all of those stop losses, which allows them to scoop up all those sell orders at a fantastic price, right before they launch the real move up. They literally used your money to fuel their trade. So after hearing all this, you have to be wondering, what is the actual edge? I mean, if indicators are late to the party and smart money is actively setting traps, how in the world does anyone win? Well, it all comes down to a major shift in how you think. This entire philosophy really boils down to this one powerful idea. There's a difference between knowing a lot and knowing what's right. Trading isn't a game show where the person who memorizes the most facts wins. The real goal is to filter out all the junk and focus only on the few things that actually matter. So the big takeaway here is this: your edge is simplicity. Your real power comes from stripping your charts bare. It's about understanding that simple story of supply and demand, reading the basic structure of the market, and, most importantly, learning to spot the traps so you can avoid them instead of falling right into them. And that leaves us with one final thought. I want you to really think about your own process, your own charts, your own rules. What is the one thing, maybe it's one indicator, one rule, one source of news, that you could remove right now to make everything just a little bit simpler?